Yeah, I put this up to always frame my talk. Since I'm from out of town, I must be an expert. So I just wanted you all to know how other experts do, historically. This is one of the sort of the fun talks I do, and what I'm trying to do in a very short time is give you some what I consider some of the real highlights or important tidbits out of the graduate class I teach on wealth management, master's and PhD students. Hopefully you'll find it kind of fun and interesting. So, and I do apologize because of the structure. I don't have anything to look at in front of me, so I have to keep turning around here. Well, there we go. Okay, 6 things to know. First one, squaring of the curve. It's no surprise, I think, to any of y'all that we're living longer today. And these are some of the statistics. A couple in their 65, one of the two is likely to live to 91. There is a general belief and a lot of research that suggests the older you get, in effect, you're going to be sick and you're going to spend less money. I don't think that's particularly true. There is something called squaring of the curve by a friend who is a PhD, calls himself a gerontological financier. But the idea is, as we get older, we may get sicker. We don't necessarily spend less. Well, Dean and I, my wife, have taken a number of really nice cruises, very expensive. And these are a couple of shots. This was at the hotel. We're getting ready to go to the ship, and this is one of the passengers. This is boarding the ship. This is on the ship. So just because people are getting older doesn't necessarily mean they're going to be spending less. So it's a very dangerous assumption, I believe, in planning. There's a philosophical construct, Pascal's wager, somewhat simplistically like this. If you knew that there was only a 20% chance that God existed, and you could decide, well, not very good odds, so I will ignore ethics and I'll just do anything I want to do. And if you died, there was no God, you won the lottery. On the other hand, if you died and there was a God, fire and brimstone forever. So the consequences, even though the probability is low, are pretty catastrophic. On the other hand, if you assume, well, low odds, but I'll still live an ethical life, you died, there was no God, still had a pretty good life. And if you died, you won the lottery. The point is, we tend to forget the consequences. Particularly in planning, we focus on probabilities and probabilities. But we all too often forget to ignore the consequences of even low probabilities. And so what's that have to do with retirement planning? It's dangerous to make the assumption that many people do, I'll never live that long. Well, if you don't, that's not really the issue. You're dead. Who cares? The risk is living longer than you think you might and ignoring that probability. Returns. We as professionals, you as investors, no controls over returns. I mean, that's a reality. There is a difference, I believe, though, in the future we all have in terms of investing, and it's referred to as the equity premium. Basically, what are you going to be earning? We've always focused as practitioners risk and return. Over the next couple of decades, we believe that there's a third dimension that is going to be equally important, and that's the cost, expenses and taxes. And this is a little table, a little study I did for a paper I wrote many years ago, and just trying to look forward and seeing what this meant if we were indeed in what we would call a low return environment. So the first column is, what had returns been in a roughly balanced portfolio of 40 bonds, 60 stocks over the last 20 odd years? You can say it wasn't too bad, 14%. Well, the cost of implementing that transaction cost, about 1%. And taxes. Well, you've got some ordinary income, some capital gains, hopefully a lot of deferred capital gains. So the effective tax on an annual basis, I made a guess around 20%. So that meant net, at 10.4%. Looking forward, I'll show you in a minute why, I believe, and now there's a pretty strong consensus, returns for the next 10 years, probably 20 years, are likely to be historically much lower than in the past. So my projection, 7.8%. Expenses don't go down. That 1% is a bigger bite out of the small return. But when I first did this, I said, thank goodness, at least taxes are proportionate. So a little less of a tax bite, that's still a pretty sobering number. 5.4% out of a 60% stock portfolio. Unfortunately, that wasn't all the bad news. I left something out. What I left out is all anyone can spend is what we call real dollars after inflation. So I subtracted inflation off of it, I came up with 2.4%. So that's the sobering reality, that returns, if indeed they are low over the next decade or two, are going to be historically very low. So what's left over after expenses, taxes, and inflation is likely to be quite modest. So what do we do about that? Since we can't control returns, we need to focus on controlling the cost of the process. And then looking at what's a solution, I saw there's something, an institutional strategy called core and satellite, which is really a simple concept. But the point is we need to focus on not just the traditional optimization of a portfolio, but we need to think beyond that in terms of the strategy. And this is what it looks like. The bulk of the equity investments are in what's called the core. Very cost and tax efficient, largely index funds. And take that risk that was spread throughout the portfolio through having lots and lots of different managers and concentrate that on the satellite. So it's an infinitely more cost and tax efficient way of implementing a strategy. This is kind of what it looks like. And in the core, I called it beta plus. Beta implies the risk of the market, because we believe there's research that suggests you get a little extra return for extra risk of investing in small companies and in value stocks. Not picking the best, simply in that universe. And around the perimeter, the satellite, those are examples of some of the kinds of satellite investments that we use. Volatility, risk and luck. This is a really sobering concept in retirement planning. This was a table done by Bob Curtis, who's the principal of Pi Technologies, the firm that develops the planning software we use called Money Guide. Real simple little picture. 3 different investors, all exactly same amount of money and the same goals, same withdrawal. The only difference over 30 years, fundamentally, was the first year they invested. The first investor, the first year, lost 10%. For the next 28 years, they're in 7.56% like clockwork. And the last year made 29%, so that the return for 30 years was exactly the same. The next investor got 7.56 per year, 30 years like clockwork. And the last one lucked out. The first year got 29%, last year lost 10, ended up with exactly 7.56 for 30 years. But the consequences were unbelievably different. First investor ran out of money in 22 years. The second investor ended up with $98,000. Last investor ended up with $1.5 million. It's referred to as sequence of returns. The point is, in retirement planning, it's not just the returns you're going to get, it's the sequence that make a staggering difference. So we're focused on what we call sustainable withdrawal in retirement planning. How much can you take out of a portfolio, factoring in inflation in real dollars, so that every year you'll be able to take out that same amount of purchasing power, real dollars. This is a classic study done many years ago by a friend, Mr. Bingen. It was a really simple idea. He said, let me look at a family that retired in 1926. And they have a portfolio, roughly a balanced portfolio. This one was about 60-odd% large cap stocks and balanced bonds. And they're taking out 6% a year. But that dollar amount has to grow every year by inflation. Now let me look at a family that retired a year later, same thing. And the question is, how long did that money last? Well, the red line is it lasted 30 years. You can see how many of those bars don't make it up to 30 years. And the conclusion of this paper was this, that at least historically, if you wanted to know how much could you take out of a portfolio and have it last for 30 years, it was just a shade over 4%. So you may have heard of the 4% rule. This is where it came from. Of course, that left out taxes. So it was really about 80% of that. Today, given where we are, in terms of a sort of a benchmark assumption, there's a strong consensus it's probably closer to 3.5%. The only problem with this paper was he called it a rule. No practitioner is going to use that as a rule. It's merely a guideline, sort of bring into reality what may be sustainable from a pot of money. Playing it safe. So what's the solution? What are the traditional solutions that most investors look to or that you read about, in the paper and the magazines? Well, there's a couple. One is target date funds. That's safe. Target date fund is one that says, okay, you're going to want the money 10 years from now, 15 or whatever, so you buy a 10-year target date fund, and the company is going to invest it and adjust it on an annual basis so that theoretically it meets your needs and it manages the risk. The closer you get, the more it's going to be moved to fixed income. The other one is the income portfolio, probably the most popular. Okay, I'm going to invest in bonds and stocks so that my interest payments and my dividend payments give me what I need every year. Both sound like really good stories and market hundreds of millions of dollars of product. Unfortunately, at least from my perspective, they're both horribly flawed solutions. First of all, the life cycle funds are one shoe that fits nobody. I mean, people aren't exactly the same. You've got two different people, they live next door to each other, they have exactly the same family size, same age. Everything's exactly the same, except one family spends more than the other for whatever reason. One may have a pension, one may not. Well, the kinds of portfolios they should be in are radically different. So a one-shoe life cycle fund makes no sense. The other problem is a lot of the life cycle funds are built into the pension and the 401k. Well, typically that's only a portion of someone's money. So to assign one little piece of it independent of everything else, again, makes no sense. Okay, let's talk about the income portfolio. Oh, I'm sorry. The other example, life cycle. This is an example. This is 2 years from the termination of that life cycle. Let's say this is in 2012 and it was originally designed 10 years ago for 2014 target date. Those were 10 different funds. As you can see, the returns are dramatically different. There's nothing whatsoever uniform about this concept of a life cycle fund. I'm retired. I need dividends and interest. I mean, that is probably the most common strategy. Lots of problems. First of all, when you restrict your design to dividends and interest, the allocation, which means how much you're going to put in bonds and stocks, is completely driven by whatever dividends and interest rates happen to be at the time. So This little example that I did a while ago, I said, okay, client needs 5%. Well, looking at what stocks and bonds were paying, the maximum stock allocation was going to be 50% because anything over that, dividends were too low combined with the bond interest at the time to make 5%. Well, controlling the asset allocation, or what that stock bond balance is based on current dividends and interest rates, again, makes no sense. One family may appropriately need a 70% stock allocation. Another one may very well be able to live with a 30% stock allocation. And not only that, the results don't make sense. This was an extension of that example. I looked at two different investments. The first one was an income solution. When I did this, basically that was 100% in bonds. The other one is what we call a total return. Design a portfolio, a balance of stocks and bonds, and then take out every year that 5%, factoring, paying the taxes on it. So this little graph says, okay, what was the difference in annual payout between what someone needed and what they got paid? Well, the red line is the total return. There's zero variance because it was designed. Take out every year exactly what you need. The blue line is the income portfolio. So you see, the first year, the income went down. What happened? Interest rates went down. So their income went down. How do you think that investor felt? Pretty bad. Gee, I don't have as much money. What was happening to the value of the portfolio? It was going up. When you own bonds, interest rates go down, the value of the portfolio goes up. So they were feeling poor, but they were getting richer. But how about a couple of years later? Wow, my income is up. You know, let's go take that extra trip. Let's go spend some more money. How were they feeling? They felt great. They felt rich. What was happening to the real value of the portfolio? It was going down. As interest rates go up, the value of their bonds was going down. So there's no relationship between the reality of what's happening and how the investor feels. So a combination of you end up with an inappropriate allocation, and the way you feel is completely the opposite of what's happening in the economy. That purple is the value of the income portfolio. It went up and down, but by the end of the 10th year, it was about down to the original amount. And in real dollars, it was less. How about the other portfolio, this total return portfolio? It went up. It wasn't straight up. It went up and down as markets go up and down. But the point is, it builds in that inflation hedge. It can be uncomfortable over time, but as far as I'm concerned, the firm's concerned, it's the only rational way to build an investment portfolio. This was the strategy back in the early 80s that we developed to try and deal with this sequence of returns risk. And wish I'd have called it that then. Morningstar at least gives me credit. What's called a bucket approach, a real simple concept, a two-bucket approach. This is what it looks like. You take your portfolio and you bifurcate it into two components. We call a cash flow reserve and an investment portfolio. We call a 5-year mantra, 5 years, 5 years, 5 years. We don't believe it makes sense to invest unless you've got at least a 5-year horizon, because there's simply too much uncertainty in the short term what an investment's going to be worth, whether it's stocks or bonds. The cash flow portfolio is divided into two parts. How much will you need to supplement your ordinary needs in addition to pension or whatever else on a 1-year basis? And are there any big lump sums that you're going to need to take out in the next 5 years? pay a college education, take a trip around the world, whatever it may be. So those funds get carved out. What's left are really long-term funds. Funds that can be invested 5 years and longer and can survive market volatility. Historically, if you invest, the likelihood of losing money 5 years out is almost zero. 1 or 2 years out can be pretty uncomfortable. Certainly, Grand Recession taught us that. So we have these two portfolios. This cash flow reserve, if you need regular income, my partner Dina Katz says the paycheck syndrome, can structure it to pay out on a monthly basis, just like a paycheck. The amount of money you need to supplement your income. And as you're managing that investment portfolio, things change over time. The market collapses. So what do? What most people do is sell out of the market. What should you do? Buy more. It's a buying opportunity. So as you're doing what we refer to as rebalancing, you look over the cash flow and say, gee, you know, we're down to about 6 months of what we need. While we're rebalancing, let's take advantage of it and fill it back up. The point is, you're not forced to sell in a bear or a terrible market, pay your grocery bills. You control when to sell. You're selling the gainers, not the losers. It's an immensely powerful concept. Back in, some of you may remember, the crash, 87. That was one of the scariest things I ever remember. Overnight, the market went down 20%. And back then, we had a pretty small practice, but most of our clients were what I called CD investors. Retired, very conservative, and I had our small staff. We were in like at 7 o'clock in the morning, waiting for the phone to ring. I tell the story now. It wasn't funny at the time, it's funny now, but phone didn't ring. I said, oh my God, they're either all dead or on their way to the hospital. So around, I don't know, 9 o'clock, I said, okay, we need to get on the phone. First person I called sounded like my grandmother. Val, what you want? I said, well, you may have noticed the market was a little rocky. And I swear to God, she said, I know 5 years, 5 years, 5 years. She got it. And she knew where grocery money was coming from. There was money sitting in cash and money market, so she didn't have to worry about selling something. I said, and we're on the phone. She said, well, I know we're on the phone, you just call me up. I said, well, I guess AT&T is in business today and they're taking Kodak and Fuji pictures at Disney World. They didn't all go broke. So I didn't think they did. But that's the whole point. If you can step back and not panic and you have a diversified portfolio, you can realize the world didn't come to an end. If it did come to an end, who cares anyway? So it is a very comforting and very powerful tool. It worked during the 87 crash, during the tech bust, during the Grand Recession. Nobody was happy, but nobody panicked. They knew where their grocery money was coming from. Real people, probably my single favorite subject. Danny Kahneman won the Nobel Prize in economics. Danny is not an economist. Danny's a psychologist. But what he won it for is this simple realization that people aren't rational in a traditional economic sense. Economists have this concept of the rational investor, that people will do things in their economic best interest. We all know that some people aren't rational, but en masse, that's how people will react. What Danny said is, that's not true. They won't necessarily be irrational, they will be normal, they will be human, And they will potentially make some very serious mistakes that are predictable. An example. Ask you, which of these lines are straight? Clearly, none of them look straight. In reality, they're all straight. But that's how our minds can trick us. This is a good term. I want to impress your friend, heuristics. All it means is mental shortcuts. We live in a very complex world. And in order to get through it, we make a lot of quick decisions based on mental shortcuts. Most of the time, that's extremely helpful and helps us get through. Problem is, occasionally, it can be very misleading, particularly in the investment universe. So for example, overconfidence. If I ask y'all, and I won't make you do this, but how many in the room, children or grandchildren above average, my guess is probably 100% of you would put your hands up. Lake Wobegon, all the children are above average. Well, clearly, that can't be the case. If I give a talk to, 300 financial planning practitioners, I say, how many, just by a teeny bit, think you're better than the average of the room in what you do professionally? 100% of the people put their hands up. We tend to be overconfident. How's that going to get you in trouble in the investment universe? I can time the market, or I can find someone who can. No one's ever successfully done it, but doesn't stop people from believing that they can, or that they can find someone who can. This is one. My advisor can pick stocks better than the most. Terry O'Dean, one of the younger leading lights in the field of behavioral economics, did a study. He had the trading data for tens of thousands of people over like a 10-year period. And ask a very simple question. When someone sold a stock, how did that stock do compared to the one that they bought with their good idea? And what he found is good ideas cost about 3.5%. They've been better off keeping it. And for females in the audience, the really good news is women have fewer good ideas, so they only lost about 2%. The point is, good ideas can be costly because of overconfidence. Another example. Looks like a duck, quacks like a duck, must be a duck, called representativeness. How does that get people in trouble? I got 2 coins. I toss one in my left hand, and I get that series, heads, heads, tails. Second one I toss, and I get tails 10 times in a row. Most people, if they look at that and I say, okay, which one's the fair coin? Everyone's going to say, well, the first one. Something's clearly wrong with the second one. The fact of the matter is, statistically, they're both just as likely. When you toss a coin, the second one doesn't know what the first one did. So 10 tails in a row is statistically just as likely as that first series. How does that trick us, represent us? We know that coin toss is random. Well, the first one looks random and the second one certainly doesn't, so something must be wrong with the second one. In the investment world, Morningstar gave it 5 stars, must be good. Morningstar is the Rolls Royce of data in our profession. I've been a fan since they started. Everything except the star rating. Lots of studies out there that show that you'd have been better off buying 1 and 2 stars than 5-star funds. Because that's history. That's how much they did in the past. It's not a very good predictor of the future. But representativeness leads many, many investors to focus. I can't remember, something like 85% of funds sold are Morningstar 4 or 5-star. Mental math. We tend to get tricked by really very simple math. Okay, your buddy, your neighbor, your hairdresser says, I got this great tip. This new company is going to do fantastic. Now there's a few steps they have to go through before it goes public. the 90% probability each one of those steps will be successful. What do most people think the success of the investment's going to be? 90%. What's the reality? 66%. To calculate the probability of the likelihood of success is 0.9 times 0.9 times 0.9. If you think about any of the kinds of investments or hot tips that you hear about, one, there's going to be a whole lot more than 4 steps for it to be successful. And they're all not likely to be 90%. So when you think about the reality of the probability of success, it's likely to be infinitely lower than your mind is telling you. This was very real. This was after the tech crash. I had a client come in, retired surgeon, sort of a classic curmudgeon, tough guy, and he was almost in tears. He said, "Harold, I don't understand. You know, I had a lot of tech investment. I was doing fantastic. Last year I made 80%. This year I only lost 60%. But my statement says I'm underwater. How can that be? Something must be wrong. I need you to, check with the brokerage firm and see what they did wrong." I said, "No. I know you thought you'd be ahead 20. That's not the case. You had $1 million, went up to $1.8 million. You lost 60 of $1.8 million. So indeed, you're behind 28%. So framing. How something gets presented makes a huge difference in how we react to it. This is an unbelievably powerful concept. You have a choice. You got some bologna to sell you. Which one do you want? The one that's 10% fat-free? I'm sorry, 10% fat or 90% fat-free? Okay? Go to the store and try and find prunes today. You'll have trouble. But if you look for dried plums, you'll find them. Okay? If I ask you to name the top 10 baseball players, painters, we would argue who belongs on that list. If I ask you to name the top 10 money managers of all time, you'd probably stumble with 2 or 3 names. Like Warren Buffett, who's not a money manager, he buys businesses. So one of the things you can do to protect yourself is if I try and talk you out of something that you really believe in, it's going to go in one ear and out the other. But ask yourself, what might go wrong? Don't just focus on what might go right. So you can do your own framing if you get really excited about doing something that could be potentially very risky to your financial future. This is the most powerful example of framing that I've ever seen.
You do to my sign?
I wrote the same, but different words.
Thanks, love.
That's framing. Okay. Here's a test for you. Another framing. You walk into Vegas, and as you walk through the door, balloons fall down, band strikes up, people are standing around cheering. Gentleman walks up to you in a beautiful tuxedo. One arm is stretched out and there's money to the ceiling on it. The other one, he's got a brown paper bag. You win. You're a 10 zillionth customer and you win. It's Vegas, you get a choice. Point to my arm and you win $800,000. It's yours. But it's Vegas. I got a brown paper bag and 10 ping pong balls, 8 white, 2 black. Put your hand in and pick a white, you win $1 million. Pick one of the 2 blacks, you get nothing. Which one you want? I can tell you 90% of the people take the money. I made a mistake. You're not in Vegas, you're in hell. Some people say, what's the difference? But okay. Devil comes up to you and says, no surprise, I'm a gambling man. Let me tell you how it works down here. Flips out his right arm and says, see, that's empty. Point to that, you owe me $800,000. Got a brown paper bag. 8 white balls, 2 black. Put your hand in. Pick a white, you owe me $1 million. Pick 1, 2 black, you owe me nothing. Most people are going to take a chance. Makes no sense. Exactly the same issue. It's framing. We talk about investors being risk averse. The reality is investors are loss averse. If someone comes and they go to my friend at the brokerage firm upstairs and they've been conservative investors, they're very likely to be told, oh, we got to make you some money here. We got to put some money in the market. And they may very well walk out. When they come in and talk to us, we may end up making exactly the same recommendation. But if, as financial planners, we recommend that someone invest more in the market perhaps than they have in the past, it's not because we're trying to make them rich. We're trying to make sure they don't get poor. Market timing, there's something called the Shiller Index. Just basically like the 10-year average price to earnings of the market. Today this was yesterday, 31.1. You can see historically that is extraordinarily high, which is why this concept of the market being expensive comes from. And historically, if you look at where the market starts in that Shiller Index, the subsequent returns for the next decade are extraordinarily low. The problem is it's not a good measure for trying to time the market because the next best year could be extraordinarily high. But the point is, we believe, and there's a strong consensus, that the market is extremely valued and long-term returns are likely to be extremely modest. Another example of market timing. This is a 20-year period, 5,200 trading days. Return was 7.2%. If you missed 10 days of 20 years, returns would have dropped to 3.5, 20, 1.2. Why would you miss those best days? Because they typically come at the very bottom of the market when everything looks awful. The green is how mutual funds did, and the red is how investors in the funds did on an annual basis. Because investors, for the most part, are simply not patient. This is sort of the markets and how people feel. Markets going up, euphoria. I feel great about this investment. As things go down, maybe the markets just aren't for me. That's when people bail out. The fact of the matter is, it should be doing just the opposite. When the markets are up, that's when we're selling stocks. And when the markets are down, when we're buying. If you believe in long-term investing, That's simply what you have to do. Everyone says they want buy low, sell high. Unfortunately, as that picture of the fund shows, most people do just the opposite. Avoid financial pornography. That's enough said. So the key is, it's not timing the market, it's timing the market. You need to be there for the long term. Okay, this is the last. I need to warn you all, this is my soapbox. I'm very prejudiced, so I'll give you that warning in advance. David versus Goliath. First of all, $100 million in the institutional world is pocket change. So we clearly have a lot of wealthy investors, but they're not in the institutional world. This is an example if you're trying to pick your own stocks. That's some of the competition out there. And it's not just the United States, it's a global universe. These are some examples I took of different plans. Korea's security deposit, $100 billion. Albertson's department store, $10 billion. Steam fitter, local 420 of Philadelphia, $466 million. The point is, there's a lot of big investors out there, and they're not the retail investors. So this is the real world, okay? Retail's the little guy on the left. David's not necessarily going to win this one. That's sort of my picture of the typical investor. You have to gain the customer's trust, before you can take advantage of them. And the ultimate answer is, I'll skip by that one. Being honest, it was your decision to follow my recommendations that cost you the money. Where does the buck stop? It stops with you. That's the problem. In the regulatory system in the United States, there's two systems, the brokerage and the investment advisor. Brokers are held to what's called a suitability standard, which is a caveat emptor. The buck stops with you, the investor. The registered investment advisor, it's a fiduciary standard. The buck stops with us. There's been a huge fight, a huge debate. We thought for a while that perhaps we, meaning the fiduciary universe, had won. The Department of Labor issued new rules, but it looks like that's going by the wayside. So this is just about a week ago. JP Morgan is telling brokers, prepare for a change in retirement account policies. Wall Street firms are poised to move quickly to reverse restrictions they impose to comply with a conflict of interest. Words, the proposed law, actually, it is in effect, have very strict conflict of interest rules. But the companies have changed to meet that. Now that it looks like they don't have to, they're pulling it back again. So, small group, we call this fiduciary oath. Doesn't have the word fiduciary in it. And I've got some copies out there. So our suggestion, anyone going to an advisor, considering advice with advisor, have them sign this simple little mom and pop statement. It simply makes very clear what your relationship with that advisor is going to be. Basically, I'm saying, give up on relying on Congress or regulators, because it doesn't look like it's going to happen. So investors need to start looking out for their own interest. So that's about it. What our business is all about. It's not making our clients rich, it's hopefully making sure they don't get poor. And this is it. Mr. Wilson says he don't want to get ahead, he wants to stay even. Want to enjoy the quality of their life. Then finally, this next one my mom sent me this one, so I always share it. Don't want to worry you, but the guy that delivered the pizza is your financial planner. So with that, thank you all very much.